Okay, good evening. This is Brian Stoll for Timing Strategies. Wednesday, December 19th. What, 6 more shopping days? 5 more shopping days till Christmas, but that doesn't matter. So, let's get down to business. Okay, we got a market that looks like it's putting in a cyclical low. Some of our systems are starting to give preliminary buy signals. We took half of our short position off yesterday, as you check our video. Right there, we were 40% short from this point here. And now we're only 20% short as of yesterday, so basically a flat day. And what's the risk that we have here? Well, I'm looking for a buy signal. I'm looking to get long. If the market comes back down, test this low one more time, washes out the lows that we have, excuse me, washes out the lows that we have of yesterday, and then also fills in this gap. All right, at that point, yeah, I'll be much more in that gap right there, coincidentally at that level on the spiders. I'll be much more inclined to be a buyer, but again, I won't be just a buyer if we close that gap and we just keep going lower and lower and lower and lower. So that's something that we have to watch out for. Eventually, I do anticipate this low of November the, well, whatever that date was, November the 26th. Yeah, November 26th. That's where we got long again. No, actually we got long a little earlier than that. I eventually do expect and anticipate that low of November 26th to get stabbed and taken out. And I also expect, in my anticipation, that low of August the 16th to get taken out also as well back here. And when that happens, you know everybody's going to be talking, bear market, run for the hills. Will it happen this year? I doubt we'll see it before the end of the year. And at what time in the future, into January, I have no idea. What I'm looking for in the short term and the intermediate term is, like I said, that move down. Hopefully, if we can get that, we can get long, potentially all the way to a move back up to this level of about 150.5, all the way up to potentially 151. There's a neat little confluence, a fib confluence right there at 151 on the spiders. If it's going to even be relevant, I have no idea. But what I want to bring to your attention too is a little time symmetry that we've got coming right now. I'm going to put the magnet on for this one. Okay, so now if we take the high from the September 11th to the low of September 22nd, we have a percentage drop of 5.6%. Now, if we take the same move starting from December 12th, ironically, to where we are as of yesterday's low, we have a percentage drop of, get rid of that, a percentage drop of 5.8%. So very, very symmetrical in a time balance. The only difference is that we have a little bit of price percentage symmetry, but we had 8 days coming in here from September the 11th to the 22nd of September. We only have 6 days coming in from the December 11th point down to our December 18th point. So I'd like to see one more day of down movement. You know, the price, the price qualifier is there. It's just the time matter is not as what we'd like to see. But again, I do anticipate a cyclical low. I could be wrong. This market, like I said, could just keep drilling and grinding lower. If that happens, well, you know, we'll manage it as it goes. What I want to bring to the attention real quick also is the XLF. You know, everybody's chomping at the bit for financials, and you know, they're a potential very strong counter trend rally move that could take us up, you know, anywhere between 10 to 15%. 10% would be easy to be done. 15% would take us all the way back up to about that 34.20 level. It's still a bear market as far as I care. And don't be, in my opinion, be seduced by these want to pick bottom moves, which everybody, being human, myself included, wants to get that low print because, again, that's the lowest risk. Remember, low risk attracts large size, and that's where the risks are the least and the profit probabilities are the greatest. But the problem is that let's go to a weekly chart. If I don't have too much junk on there, you know, and that weekly chart, yeah, we're going farther. That just does not look good, my friend. And eventually, I anticipate that XLF is going to wipe out the lows that we put in back in 2004, which really aren't that much further below where we are now. Oops, that's just a, that's not it. That's it. So at 26.50, 27, that's really not that much farther lower. You know, another percentage move of only about 10%. That's a little more than I thought it'd be. But again, that's going to drive the market lower eventually as well. And ultimately, are we going to get these bottoms that we're looking at for down here? That's very possible. Take a look at Citigroup, if that's not there. I mean, Citigroup stock is almost already back to the 2000 lows. I mean, that's ugly. Look at Washington Mutual. I mean, that's already way past the 2002 lows. So are the financial sectors worth buying? Yeah, there could be a very short-term, quick bounce coming in here. But, I mean, on a trend basis, long-term and industry sector-wise, you know, this thing is just, it's just bleeding. And that's about all I can say. Let's take a look at the EEM. Emerging markets, again, all the money going into overseas international, the hot money, the fast money. Don't stick around. I think that party's about over and done with. Keg is dry, and this market can be down 10% in one day. We're looking to put on a short position with the, we have a small position with the EEV already. We're looking to put on a bigger short position if we get the right location. Another point to bring in is the FXI. That's the Chinese market, my friend. You know, that again, just to me looks like we're headed lower to about the 141 level. On a percentage basis, what's that going to produce? Well, as of today's close, we've got, just on a percentage basis, about a 17% move lower, 15% move lower. How can you capitalize on that one? Well, the FXP, that's a negatively correlated Chinese ETF to the FXI. But again, location and risk management is the key on that. Let's take a look real quick at the XLE. And again, I'm anticipating low oil and oil stocks to start heading lower. I think they're putting in a top. My cycles and everything that I use, our analysis is telling us it's really not worth trying to squeeze a few more percent to the upside out. If you're already long, get out. If you're looking to get a short, you know, maybe now is the time to start looking at it. But again, key entry location is the most important element. So we want to see something that gives us a reason to get short. What that will be, it'll present itself when it gets there. Let's take a look, one last shot at the XLB. You know, material stocks can't, I think, get too much more to the upside as well. There's a deflationary smell in the air, and everything is just starting to either stagnate. Again, markets chop at a top, meaning they're very volatile. Bottoms are quiet. And we're starting to see this volatility with a lot of swings with very little price movement on a trend basis, all the way back to how far, you know, middle of the year, May, June of this year. So again, be cautious if you're a long-only investor. If you like to exploit both sides of the market, consider maybe small positions for the time being due to the Christmas and Santa Claus season, using some negatively correlated ETFs, or take a look at our RIDEX managed account system. We also use a Schwab institutional ETF managed account platform, so it allows us to exploit just about any direction of the market using any vehicle. Until tomorrow, we'll see what happens. I'll update this again, and like I say, Merry Christmas, Happy Hanukkah, and enjoy your day.